Emerging market currencies and bonds, these are the casualties of a trade war playing out between China and the United States. Tonight, we are going to go on a voyage with Kyle Burgess, portfolio manager at Nedbank Private Wealth, to examine the winners and the losers of the trade war. Kyle, thanks so much for your time. It's been a long time.
Yeah, it has been a while.
And we're meeting under worse times in terms of volatility on the stock market. I mean, things are really heating up in the trade front in terms of the tensions between the US and China. First of all, I'd like your assessment on what's going on and what you are doing to protect any form of wealth you still can in your portfolio.
So I think things are getting very difficult because you've got the trade war, which is obviously a significant event in all of our lives. And we can see that, I mean, the effects on, as you mentioned earlier, bonds, what we're seeing happening in the currencies. But this is also at a time when the UK is not exactly flying. I think they reported some pretty poor GDP numbers a couple of weeks ago, which is not great. The US has cut interest rates for the first time since the financial crisis. So the world is in flux at the moment. So the trade war certainly affects SA investors. I mean, you know, one thing is that we are about 0.5% of global trade. So as soon as something happens in the US or China, of course, these are economic powerhouses, they're going to affect our markets, which in turn will affect our portfolio. So certainly is a difficult environment, and you're dealing in, trades are very complex, and it's a very difficult thing to understand. But the fact is that the way that we're seeing it here at home is its effect on our currency, and that notwithstanding the issues that we're seeing here at home, potential IMF bailouts that guys are speaking about, the Eskom issues. So it's driving our currency. You know, I think we were chatting earlier before the show that 1538, 1539.
Crazy moves.
It's difficult. So it's in this context that we're trying to manage portfolios, and protecting capital is really the number one concern at the moment.
Exactly how are you going about doing that? I mean, you're looking at the Rand right now at 1530 levels. Is this time to beef up on your Rand hedge exposure to, potentially benefit from the currency translation? And if so, I mean, which Rand hedges do you pick up?
So I think what's important is, first of all, your asset allocation. You need to be comfortable with your asset allocation. I think it's become very difficult to get away with the sort of 80-20 sort of equity other split in your portfolio. So I think it's very important to have certainly some cash holdings, but also just you've got some bond holdings, or at least some form of fixed income in your portfolios to hedge you against your stocks. And I think even if you look at it just at an SA Inc. sort of context, we've had the likes of Woolies, for example, Aspen, sign off. This is some time ago now, though, but it's big blue chip stocks that have fallen 50, 60, 70%. So asset allocation is very important.
And so what would the ideal split be then, if not the 80-20?
Well, I think that really depends on your sort of life stage and a client's life stage and what they're looking to get out of their portfolios. Certainly clients have some restrictions in what they can and what they can't buy. A lot of them will have income requirements that they need to fund their retirements going forward. So it really depends on what your sort of individual requirements would be. So I think once you've had a look at that, I think, and you're happy with your asset allocation, you've got some, and it's often difficult for investors to, and particularly retail investors, to have a look at their bond exposures, because it can be an intimidating asset class. But there are some great funds that can give you diversified exposure to corporate and government bonds sort of across the board, which is something nice to add to your portfolio in times like this. But also, like I mentioned, just having some cash ready to deploy into the market, because really, what we are seeing is that in times like this, great opportunities present themselves. And, if you look back late 2015, early 2016, during Nene Gate, when Nene was fired, if you had to pick up retailers and banks then, you would have done pretty well. And this is, if you look at it since then, it's really been a benign economic environment. So valuation is particularly important when looking at stocks, even though that the economy is not performing very well. If you buy at an attractive level, stocks will outperform.
Just going back to the original question about beefing up on your Rand hedges. You were talking about buying at attractive levels. I mean, would these be attractive levels, or if you haven't been here, it could be too late?
Yeah, so that's the one thing that is difficult, because now Richmond would be something that you'd like to hold in your portfolio, but would you be buying it at 125 Rand or 130 Rand a share? Probably looking quite expensive. And really what you've seen with currency fluctuations is that they come back quite relatively quickly. Crises don't tend to last for 6, 7, 8, 9 months. I mean, we're at sort of 11-month lows at the moment on the Rand. And the same thing goes for taking cash offshore. If you take cash offshore close to 16 Rand, it becomes very difficult to be based in a high inflation environment and continue to get good returns from your sort of dollar-based assets. So again, I think its position size is very important, and asset allocation is probably even more important. Maybe moving on to some stocks that might weather well during a sort of economic downturn globally, potentially looking at something like Mundi, for example. This is a sort of diversified paper and packaging business, which has those traditional defensive benefits that something like British American Tobacco used to have. So it's currently trading at about a 10% price earnings. I think it's 11% forward PE actually, and a close to 4.5% dividend yield, which is would be a potentially great position, to add to your portfolio going forward.
But people are saying, hold up, I thought people are not, reading newspapers or magazines or using as much paper anymore because of climate change concerns. So what's the appeal around Mundi?
Well, I think it really just, they've got a diversified paper and packaging. So it's really, and if you look at the sort of e-commerce play, guys buying more internet or doing more of their shopping online, that comes in packaging, which Mundi could benefit from. So there's certainly trade-offs in it. And I think, what's important is you could use this as an excuse to be 100% invested in cash, and it becomes a very defendable position, because if you have been invested in cash over the last 5 years on the JSE, you'd have done reasonably well, right? Because inflation's not exactly run away, and in a decent money market or fixed deposit, you're earning 7-8%. So that's a very defendable position versus equities that you're taking on equity risk. But what's important is we're looking forward 5 to 7 years, not for the near term. So it's important to be cognizant of the rand, but ultimately you want to buy quality businesses at fair prices, which gives you a lot more breathing room in the long run.
And what about some stocks offshore? In times of trouble, we have seen many alcohol companies specifically doing quite well, because it's I won't get into the detail there, some offshore exposure, and perhaps the likes of your AB InBevs or the Diageos.
Absolutely. So AB InBev is a great example of that. It's run a little bit now, but this is a global play, positioned all over the globe. They cover 30% of the beer market. I mean, the investment case is sort of well documented. So that's certainly something that you'd want to be in. Another one that clients potentially haven't looked at is FedEx, which is, I think they're the number one or number two express delivery business in the world, or certainly in the US. They cover 220 countries and cover 99% of global GDP. They're certainly going to come under a lot of pressure with the trade wars, but the fact is this is a good opportunity to pick up a quality business that's trading at a far below its sort of average PE of 15 times. So it's trading at close to 11 times earnings, a dividend yield fairly slim, 1.6%, but a good business that you could potentially pick up. There's some health warnings to this because it's right slap bang in the middle of the trade wars. But the fact is that this is a high quality business that you could pick it up. So I think it's also a mind shift change to say, okay, well, this is the environment that we're operating in, whether it's Brexit, whether it's the trade wars. Let's use this to pick up some high quality businesses at very attractive yields. I mean, Warren Buffett was buying Goldman Sachs in the middle of the financial crisis. That's done particularly well for him. So I think what's difficult is identifying those high quality businesses that you want to own and knowing what price you're going to pay for them. Would
Apple be one of those high quality businesses?
Absolutely, but at a fair price. I'm not sure what that price would be, but at a fair price. It's not a stock that I cover too often, but or even look at too often. But it's a business that I like. Very cash generative, got a lot of cash reserves. But any investment is great. Well, not any investment is great, but there's a lot of great investments out there. What's important is that you pay a fair price for them, and you can bring that back to South Africa and look at the rand as well. Is this a fair price? Is this a fair price to be paying for Richmond at the expense of to give you offshore exposure immediately? I'm not sure it is looking particularly cheap at this point.
And then Kyle, I mean, let's talk about the safe havens, as you were talking about asset allocation. Is it traditional safe havens that we should be going into? And we've seen a big rally in the gold price as a result of all the uncertainty, but we've also seen a rally in digital safe havens like Bitcoin. So how are you picking between those two?
So gold certainly does seem, and this is really also a flight from the dollar potentially, because what you are seeing is that these sort of unintended consequences of the trade war are the Chinese not defending the value of the yuan anymore. We've seen that going over 7 to the dollar. You're in an environment now that this could potentially affect where the dollar's going through the Fed lowering their interest rates to be not more competitive, but to be more accommodative for a potential pullback in the US economy. So yeah.
All right, and just finally, I mean, Kyle, given that these trade tensions are expected to go on for a prolonged period, especially many are saying that we could see it go into President Donald Trump's second term if he gets it beyond 2020. What are you doing in the meantime to ensure that your clients are not frowning too much in this environment of uncertainty?
So I think it's a given that it will continue for certainly, and it's something that I've actually looked at quite closely, is that trade wars and trade negotiations aren't a 6-month or 12-month affair. They're generally 5 to 10 years. That's how long it takes to negotiate trade terms. So I think that this is a given that it's going to continue for quite some time. So if you get comfortable in that, and you say, all right, well, we're going to be in a sort of a risk-on environment or a risk-off environment, how do you position your portfolio? So be invested in cash. Make sure your portfolio is diversified, but not diversified and so, well, I've got 30 stocks, that means I'm diversified. Making sure that you're diversified, you've got some cash on your portfolio, you've got some potentially onshore and offshore holdings, whether it's sort of direct offshore businesses that are listed on the JSE or an offshore portfolio. And I think that's really what you're trying to achieve, making sure that you're not taking hugely speculative bets, and certainly position sizes is paramount in this. You mentioned Bitcoin earlier, gold, and you've seen gold running nicely. We didn't mention Bitcoin, but a digital safe haven, which it seems that Bitcoin has become, isn't it? But gold, I mean, you've seen that going from 1,200 to 1,500. So yeah, again, resources might be a nice place to be at the moment.
Really, because I mean, even though, just lastly, very quickly, so resources, we have seen those mining companies ready. Last week, gold companies coming off quite strong on the back of that metal price. But given that this trade war is expected to impact on global growth, what is the long-term outlook looking for these mining companies as China slows down, as commodity demand is expected to slow down, which could likely hit into their bottom lines? I mean, is it time to unwind from your resource position right now, or stay put?
So I think if you look at your diversified miners like BHP Billiton, Glencore, Anglos, I think Glencore, for example, comes with some additional risks that is sort of operating in Africa that maybe potentially BHP doesn't have. They are looking fairly expensive. Commodities I don't think they'll sustain the long run that they have had. So you could look at potentially unwinding or just lightening up on these positions going forward. But platinum miners, for example, palladium has run and has had a great run, and that's really fueled the likes of Impala. Platinum hasn't had a phenomenal run. So you could potentially see a lagging platinum price or a kick in that traditionally lagging platinum price, powering them a little bit more forward. So I think it is stock specific, right. And there's different arguments to be made.
Right. Well, Kyle, thank you so much for telling us exactly why we should care about the trade wars, exactly how they should impact us, and giving us that advice to relook our asset allocation split. That, of course, was Kyle Burgess, who's a portfolio manager at Nedbank Private Wealth.